Hello everyone, good evening to all of you. Today we have a very interesting webinar again, and after a very grand success of confluence of top portfolio managers in India that we had organized over last weekend, where Samit was also one of the portfolio managers. We are doing one-on-one discussion with Samit on a very real topic. I will come to explaining that topic and give a context. But before that, I want to thank all of you who have come and joined that confluence, because it has been a grand success and we got a great response in terms of appreciation. And if any one of you actually missed that and was not able to attend that, it is still available on the same link, which is pmsaifworldsummit.com. I repeat, pmsaifworldsummit.com. You can go there and watch that again. All the recordings are available. Now I will give you a quick context to today's webinar. Every one of us, is looking forward to next decade, in terms of returns. And as I mentioned, as a core theme of the confluence that we had organized, that the agenda that we have taken in our hands is that we want to take investors' focus away from risk to returns. By that, I want to say that risk is important. It is important to comprehend risk, but it is not important to actually focus too much on risk. Next decade is about returns. One should focus on returns. Last decade, for example, was too good in terms of growth, in terms of performance, in terms of returns. But despite that, the guest that we have today has a track record of having generated 30% CAGR return. At a 30% CAGR return, one grows one's wealth by more than 10 times. But today, we are wanting to understand from him the real niches of identifying businesses with the context, with the aspiration of investing for 10x returns in 10 years. And, I will also like to add that in the recent confluence, we understand from another guru, Mr. Ramdev Agarwalji, who mentioned that he foresees that next 10 years will actually provide a room for our Sensex to grow by 4 times, from 50,000 to 2 lakhs. Obviously, these targets are not exactly time bound. We understand, equities are not a linear products. They have an element of volatility. There is no assurance of return. But the fact is the focus has to be on returns, and to grow 4 times in next 10 years is a CAGR of 15%. So if index can grow at a CAGR of 15%, there will obviously be many businesses which will provide an opportunity to grow at maybe a CAGR of 25%, which is exactly what we are looking forward to in terms of today's discussion. So now I will give you a context and I will give you a background of the guest that we have today, Mr. Samit Vartak. Mr. Samit Vartak founded SageOne Investment Managers 10 years ago. And before that, he did a brief stint of around 5 years with a private equity fund. And in terms of qualification background, he is a chartered financial analyst, an MBA in finance from Washington University. So, he has 20 years of experience. The first part of his experience was with consulting firms and with private equity, space of investments. And the last, 10 years, the second part of, second half of his, 2 decades of experience has been with managing public money into the listed space, where he has managed to grow to around 2,000 crores of assets today, SageOne Investment Managers. And, the core forte of SageOne Investment Managers is, focusing on creating high conviction, concentrated, balanced portfolios in the mid and small cap space. So portfolios are not too concentrated, not too diversified, and that is why I have used high conviction, balanced, but yes, focused and concentrated portfolios. Over to you, Samit. I would like you to now begin with this, quick introduction and background. We are wanting to hand it over to you to understand from you. First of all, please share with us your learnings, of your work that you have done over the last 2 decades, in terms of what are those real niches of identifying businesses early in business stage, in terms of making and expecting a return kind of a 10x in 10 years.
Sure. First of all, really thankful for giving this opportunity as well as really kind introduction, Kamal. Can you hear me properly?
Yeah, absolutely. It's fine. Go ahead.
So let me set up a framework of when we talk about 10x in 10 years, at a portfolio level, right? There will be only few companies which will deliver that kind of returns, which contribute 10x in 10 years to the portfolio. So, for example, if I build a portfolio of say 10 stocks, out of which even if 2 stocks, deliver 30 to 40x kind of returns, and the remaining portfolio delivers just market returns of 12-13%, your portfolio returns are about 25. Are about that 25% CAGR, which is 10x in 10 years, and that's been, when I look at my past record, it's the returns are concentrated. And let me take you through the drivers of what exactly drive. Now it's almost impossible, or very very rare, that the top line will go up by 10x in 10 years. Typically, I've seen that even if it's a fast growing company, the top line grows at around 17 to 20%. So you can't really try to find out companies which are going to grow at 25-26%. Right? So you start with that kind of a framework, saying that the top line would maybe go up 5x in 10 years. Which is about that 18, 19, 20% kind of return. Then, if you are looking for companies which are which is getting into little higher value products, as well as when the scale goes up, typically, if you look at a typical multi-bagger, the margin expands. So the margin probably over the 10 years maybe would double the net margin. So that adds that 2x kind of return. And I looked at historically over all those 15, 20 multi-baggers that I have had, and this is a typical pattern that top line will go up by 5x, the margin expansion will contribute 2x more. That takes you to that 10x in 10 year kind of returns. Now the third element is also very important, because the valuation, where you start and where you end, is what will drive the returns. Because this is the two factors that I spoke about is in your hand. That's something where you can analyze, you can do in-depth work, and probably try to evaluate whether this is possible or not. The third factor, which is the valuation, is completely out of your control. Again, I will go into details of what will drive that valuation also. But what I've seen based on the historical multiples is that the valuation, if you get the business right, the valuation itself goes up by 2x to 5x. So, for example, Bajaj Finance in 2010-11 barely was 1.5 times kind of a valuation. Now price to book. Now today it trades at like 9 times kind of a price to book. So if out of the 10 stocks, those 2 that you get right, has that 10x in 10 years kind of a earnings growth, and it also adds that 2 to somewhere around 6x of valuation multiple. So those 2 stocks tend to become like either 20x or 60x, and that's the one which adds that alpha, which takes your portfolio to that 10x in 10 years. The rest of the 8 stocks, you will be God that all of your 10x 10 stocks will become out of those 1 or 2 maybe are loss making. Key is, when you lose money, how do you not lose too much money? Maybe 20-30% loss is good enough, but the remaining 8 stocks, if it delivers that 12-13% kind of a return, then your overall portfolio delivers that 10x in 10. So it looks very difficult, but it's all about how do you get those 2 stocks right. For me, a lot of people do try to focus on the demand side, okay, but what I have seen, demand is little easier to estimate, because you can do some kind of parameters, population growth, or some kind of formula that you can use. I think the difficult part is how do you estimate the supply side, right? And what I mean by supply side is that most of the multi-baggers that you see, let's say, for example, the most popular example is Amazon. Right? What did Amazon do? Demand didn't grow up by that size. It's more of it destroyed its competition, or the brick and mortar stores. And then it's tried to get into more and more territories. It started with just, say, a bookseller, but then it got into all kinds of. So it captured more and more markets, but it destroyed the competition. So it just took more and more of the pie of all the businesses where it went into. So that's an extreme example. But even at a normal conventional business level, the same kind of thing happens. I'll give an example of Balkrishna Industries, right? So that's been a good big multi-bagger for us. Now it is one of the cheapest. So they manufacture off-the-road tires. So basically the tires which are used not for car or two-wheeler, but which are used for big agriculture equipment or mining construction equipment. Now that market was completely dominated by the big brands, Michelin, Goodyear. They have these niche Titan International in the US. Right? Their cost of manufacturing was double that what Balkrishna manufactures at. I mean, their employee cost itself is 25% plus of sales, whereas if you look at the Balkrishna's P&L, it's barely 5-6% of the. So inherently, it had a advantage of cost. Right? Secondly, when you look at from the supply side, China wasn't a player which could get into this, because China looks for huge automated, massive volume manufacturing, whereas this is a little more customized manufacturing. You barely manufacture 4 or 5 tires. That's how you get the orders. Send me 5 tires of this 50 or 10 feet kind of a tire, right? So that's where employee cost plus this customization restricted a lot of other players to come into this space. And slowly it started with just supplying the replacement tires. And then as it got bigger, it started selling to the OEMs directly. And now 25% of sales comes from OEMs. Now once the OEMs start recognizing Balkrishna, as well as the dealers start knowing that there is not much of a difference, why would they buy something which is at twice the cost? Right? So even if Balkrishna was selling at 35% kind of a cost, it was making more profit than the others. Right? So basically it was a disruptor of the existing players, and that's where it gained market share. I mean, it has grown at 23-24% for the last 25 years and even last 10 years. Right? So that's the disruption that you're looking for. That industry may not grow there, but if you have a disruptor that will take away market share from others, that itself creates the growth. Even, for example, I've spoken a lot about like APL Apollo, right? The structural steel pipe. If you look at its industry, it hasn't grown much in the last, say, 5-6 years. But if you look at the trigger for it was that the technology they brought in, the direct forming technology, which is basically manufacturing these pipes with very little setup cost change. So setup time change, right? So when you say switch from 2x2 inches pipe to 3x3 inches pipe, it used to take 24 to 48 hours to switch the entire. It's a long, tube mill, which the entire molds have to be changed physically and takes a lot of time. That wastage of time basically stopped, went down to 1 to 2 hours. Right? So what it enabled APL Apollo to do is that it could now take smaller orders. So any distributor who wanted a maybe small quantity of pipe, it could get it in 2 to 3 days, whereas the other players would maybe have to wait that let us consolidate the total quantity across multiple distributors, and they would supply in 3 weeks or 4 weeks. So that's the disruption when you have large size where you are the lowest cost manufacturer, plus you have the technology which no one else has, plus you have the brand. All of that put together, it just destroyed the competition around it, and that's what is enabled them to go to that 20%, 20-25% kind of a growth rate. And when you destroy competition, it gives you pricing power and it gives you that margin expansion. Whereas if you are just part of a normal industry and you're just one of the, typically you'll grow with the industry, you cannot really grow bigger than the higher at a growth rate than the industry, as well as you can't improve your margins. So this is the most important aspect which you can study, and that is something which, if you look at that business strategically, you can really evaluate that opportunity. I mean, even when you look at, say, Amara Raja batteries against Exide, in 2012-13, Amara Raja was a distant second player. But when you look at its cost structure, it was way lower than Exide. And so then it decided, because Exide was anyways already entrenched into the OEMs, and OEMs don't switch that easily. So Amar Raja decided that I will go after the replacement market, because that was more of unorganized. And given its price point, and it was charging 15% lower than what Exide would, it easily captured that market, which was completely driven by unorganized sector. And then slowly as it grew, and then when it spent on marketing, branding, and then it entrenched into the OEM side. But it gave huge growth opportunity. I mean, for those 5 years from 2012 to 2017, you would see that Exide was flat growth, whereas Amar Raja was growing at 20-25%, right? In an industry which was, I mean, the top player was not growing at all. It wasn't about the demand side; it was all about the supply side. They destroyed the suppliers. And that is a more longer term sustainable kind of an advantage. And that's what all of these, even the new age technology, that's what is the key behind that. And so, I mean, that's what we try to look for. And that is something that you can track, evaluate, go on ground, try to study, talk to different players, to talk to the supply chain, and find out. I mean, same thing happened with Deepak Nitrite, right? When Deepak Nitrite was already into the performance chemicals and the normal chemicals, as well as specialty chemical, fine chemicals. But then they launched the phenol plant. And when they launched the phenol plant, question was whether the distributors will buy from Deepak Nitrite. So when you went on the ground and asked around, like, how does that importing of phenol works, then you realize that importing involves bulk buying, plus the storage is very risky, given that it's a chemical after all. It has a lot of hazardous properties, plus logistic transportation that itself costs them 15%. So working capital cost, logistical cost, storage cost used to be 15%, and it used to take a month of planning. Whereas, when Deepak Nitrite came in, they could supply it in a matter of 3 to 4 days. Why wouldn't players switch? And after it's a commodity, so if the commodity is of the same quality and that's what we looked at, that it inherently just had that 15% advantage, and there was no supplier, and whatever was the import was the supply side. It just shut off. People already switched from. So demand didn't go up. It was more of the supply side which went up. And that's what has been, the key behind most of the multi-bagger. Of course, if the demand also supports, demand is something which I don't know whether it's a reliable, metric. But if it supports, then you get a super multi-bagger. That's what you look for. And then I will also talk, maybe later part, how valuation also is a key driver. What are the parameters which drive the valuation? Because getting in at the right valuation and understanding that what a promoter can do in a business, which will change their valuation completely orbit itself. So maybe we can talk about it later.
Sure. This is quite interesting. The question that comes to my mind, if I put myself in an investor's shoes, is that most of the examples that you have taken are around 15,000 crore to 20,000 crore kind of market cap companies today, right? Now, for next 10 years for 10 times returns, which means we have to either believe that these companies will become 10 times in terms of market cap from maybe 20,000 crores to 2 lakh crore over the next 10 years, or we identify some of those companies early in the life cycle, which are today available at maybe 2,000 crore market cap or even lower than that. Right. So I want to understand your overall, thought process when you create a portfolio in this context, and also, obviously, today we understand all these names like APL Apollo Tubes, Polycap, all these names are known to most of the investors. But the art is, or the science is, to identify some of these companies maybe early, and there. I do not know. What would you look at? If I were to look at, I would look at maybe who are the people behind that company. because to management is what I think the subjective aspect, but the most important aspect. So I am also one of the founders, right? So I see the most important aspect is what is my passion, right? What is how many hours I am working, and what is my skill set, what is my area of focus, how true I am to work with which I am doing, and obviously financials and other things will follow. But when you will identify and create a portfolio, what are the factors that you will look for and create a portfolio, and what is the kind of average market cap that investors can expect when they invest in your portfolio? Because we are obviously talking about next 10 years.
Right, right. No, that's right. I mean, that's the key reason why I am invested into the small and mid cap, because you don't find that in large cap, right? If I enter itself at say 30,000 crore market cap, how can I expect that company to be 3 lakh crore? I mean, there are very few of such companies which are available. And again, I'll be very frank. However confident I could be, I would be maybe confident about the next 2 years or 3 years. Beyond that, there are a lot of luck which is involved. How the business emerges, from that point in time. So I will always look at those periods like 2 to 3 years. Then again, as you go forward, you just keep on looking 2 or 3 year period. I have not had any company where I have taken kind of a 10-year kind of a way. It's just impossible to do it. You just take 2 or 3, and if it still fits what you are looking for, you keep on holding it. So like for example, Bajaj Finance, right? So Bajaj Finance in 2010, everyone knew that in 2003 to 2007, it was purely a unsecured lending, basically lending personal finance and then two-wheelers, three-wheelers. There's nothing beyond that. Then the management completely changed. Rajiv Jain came in. So however promising you found Rajiv Jain, could you predict that he would be able to execute it? Because execution is one of the biggest thing that you would look for in a promoter, right? Other things are completely subjective. I don't know. I mean, how the integrity of promoter, all of those are completely subjective. I don't even want to take a call on that. What I would see is he completely aligned with the minority shareholders, and whether he has the execution capability or not. And so when Rajiv Jain started executing, switching from those just two verticals into getting into mortgage and consumer financing, and then even hospital financing, furniture finance, all kinds of different verticals, the execution was the key. So you get to know as it evolves, it unfolds in front of you. So you just take a view for a couple of years, and then you see how it is executed. So similarly, even today, when you look at opportunity, I mean, your starting point has to be in that 5 to 10,000 crore range. That's where you can expect that. And again, I don't expect to go to 1 lakh crore, from that point. For me, I'm looking at how can I maybe double my money in 3 years. So that 5,000 to 10,000 is what I'm looking at. Beyond that, I really have no idea. And I don't have to hold to the same stock for the 10 years, right? It's just that most of the stocks, if you get it right, they will become 8x in 3 years. And some will not even double in that 3 years. But that is the key, that if you want to spread your bet across, say, 15, 16 stocks, you want to see that there is a potential for, almost all of them to go to that sort of 8x in 3 years, or, 10x in 4 to 5 years kind of returns. And those are the kind of companies that you look for. And that's where, as I said, this is what I look for. The parameters are that, sort of 20% kind of growth on the top line, margin expansion potential, where, it can add 5 to 6% more growth just based on margin expansion. And then the third way is basically getting entry at cheap valuation, which is not in my hand. Like in today's environment, there is no way I can where I can expect multiple to expand. When you are entering itself, I mean, I would be lucky enough that in 3 years or 4 years, these multiples will even sustain. But if I get my fundamentals right, that the earnings have basically doubled in the next 3 years or 4 years, then I have a lot of cushion. Even if the valuation contract by 30%, I still make decent money. And that's the best you can do, because these are the kind of companies which will generally outperform the market by about 10%. Because typically the longer term growth rate for earnings, will be around 14-15%. It can't, and that too in the best of economies. And if you are delivering 25%, that's the alpha that you can add, and that's what you can do. You can't always get cheap prices. It's once in a 4 or 5 years that you really get those cheap prices. You have to bet on businesses. Valuation is something which you have to take in your stride.
Right. So you mentioned that you will, after identifying the company, adding into your portfolio, creating
Kamal,
a
your voice is a little lower.
Achha. Is it clear now? Is it better?
Can't hear you much.
Can you hear me now?
No.
You can't hear me? Okay.
I am not able to hear you, but maybe someone else. If
Am I audible to
yeah,
everyone?
perfect.
Okay, perfect. Right. Sure. So, so far, you have mentioned that first of all, you would create a high conviction portfolio of say 15 companies, around 15 companies, right? You will stick to identifying companies early in the life cycle, maybe 5,000 to 10,000 crore of kind of a market cap, right? And then you will take and see that company, each quarter, or maybe with a horizon of 2 to 3 years,
yeah,
right? And you understand based on your experience that these 15 companies are not going to give you as a 10x return, but few companies like 2 3 companies will give you 20 30x return,
right.
and maybe remaining 10 12 companies will give you 3x to 5x kind of return, and overall portfolio will give you 10x return.
Right.
So that is how a high conviction portfolio will deliver.
Yes.
And to an extent, obviously, over a period of time, luck and fortune will also matter.
Yeah.
But you will, do your research and your analysis on an ongoing basis over a period of time.
Yes.
Now, at this juncture, when you are invested in a company like Deepak Knight, right? You are invested in a company like APL Apollo Tubes. You are invested in a company like Polycap, for example, right? Now, how will you identify? At what stage will you identify that now the thesis, at which you had entered into this company in terms of expecting a high growth is kind of going down, and you want to exit? What has that happened in the past? Can you give us some examples? What to look forward in
Yeah.
terms of identifying?
Yeah, I mean, absolutely. There are a lot of examples. I mean, for example, so see, the thesis is that if at any point in time, if I don't see the potential of earnings doubling in the next 3 to 4 years, I can't say 3 years, but 3 to 4 years is the range I would give. If I don't see the earnings doubling in the next 4 years, that's a trigger for me to exit that company, because there's no point in having the company which is not meeting your parameters in the portfolio just because it has done well for you. Right. So a lot of, I think, investors have that misconception that, okay, if the company has gone, say, double, they will book the half the profits and think that, the remaining is like risk free for me. That's not a concept for me. It is all about, from today, the portfolio has to, each and every stock has to have the potential to double in the next, irrespective of when I bought it, doesn't matter, because for PMS fund manager, investor comes in every day. I mean, you can't just rely on your past performance because he's not going to get it at that price, right? So for me, every day is important. If I'm not selling that stock, it means that I'm as good as buying that stock today. And if I'm not comfortable buying that stock today, why should I have it in my portfolio? Maybe I can keep it for a little while, but I should have the conviction to buy it for a new portfolio too. So every point in time, you have to evaluate whether there is a potential for doubling in 3 to 4 years, right? So, for example, now Laopala, that was something which actually went up 5x in 1 year itself. This was then, but then there was a trigger that for the opalware, category, government put an anti-dumping duty on, the opalware from China and Taiwan and all, and that market was 50%. So since Laopala was the biggest sort of player in that market, it immediately should be able to capture. So that's the thesis with which we went in, and then it put up new capacity and then delivered. But then that is a short window. Once it captures that market share, where else will it get its demand from? Then it drops the sales growth from that 20% to maybe like 5 to 6%, which is sort of the. So as soon as you see that the big market share gain is already happened, there's nothing left. You just get out of that company. Even Kaveri Seed, Kaveri Seed is something where when we entered in, its market share was just 5%, because Nosy Video was the big player which had that 15% plus kind of a market share, and we thought that based on your groundwork that Kaveri had a better seed than Nosy Video. So why should it not be able to gain similar kind of market share of the total? And that's what we thought, that it should happen in the next 5 years. So 3x growth, you'll get it just from market share gain, 5% to 15%, plus the overall market itself also grows. The industry itself grows at 3-4% per year. So, and then it played out in 3 years itself. When you see that playing out, there is not much left for market share gain. Then you take a call that, is there further such doubling possible? Not you just get out. And this is what you do for every company in your portfolio. You can be a little flexible on the valuation side, but on the fundamental side, if this ingredient is missing, you can't just rely on valuation, because if this doesn't deliver, even the valuation will fall and you would take a big fall.
Yesterday I was sitting with one of our clients and he was showing me the graph of mid and small cap for last 15 years. And this is exactly, where this particular point comes, which I'm trying to make, which is timing the market versus timing the market, which most of us, quote and try to educate investors that one should not try to time the market. But the real, I would say fact is that, including myself, I am also an investor, right? It is very, very difficult not to time the market, especially when it comes to mid and small cap space. Now, if anyone has to enter at this juncture, a fresh inflow into mid and small cap space, one tries to see the historical graph and one tries to kind of feel that I am entering at a kind of a peak level in terms of prices. And it has happened in the past that whenever one tries to enter at a peak level, after that one has to face a pain. Obviously, if one is invested in good businesses, ultimately after a period of time, that pain turns into gain. But still, one tries not to, in fact, get that pain for the initial 1, 2, 3 years. And nobody can try to time the market. But I want to understand from you, do you see this bull run that we are seeing currently, which is a mid and small cap bull run, different from the earlier bull runs? Do you see we have reached closer to the peak? Or is there a way to analyze or kind of assess when peak, can be, kind of sensed, or we can kind of give a nomenclature to it that it's a peak? We can kind of come to that judgment. Is it ever possible? Are there any parameters? What are your views of the current mid-cap rally in that regards?
Right. See, I think the big difference between, I would say 2017 and this rally is the quality of fundamentals of the mid-cap and small-cap. So I have spoken about this, is that, the entire universe has gone through a huge deleveraging. The debt-to-equity ratio, which used to be 1 times, has dropped to almost like 0.3 times kind of a multiple. Right? So that is one big difference, which gives you a lot of cushion. Okay. Second, the cash flow generation today is very high. If you look at the cash flow from operations as a percentage of net profits, it itself is 120-140%. In 2008, it used to be like below 70%. So that also gives you that it is generating cash. The book profit, which is used in the P multiple, is not just on paper. Actually, the actual cash flow is more than the book profit which is used for the P multiple. So actually, if you look at the sort of market cap to cash flow ratio, it is way better than what in 2017 or say what would have been in 2007, 8, right? And the reason for crashes typically is that a lot of companies collapse. There are a lot of companies which are over leveraged, could not pay off their debt, and in 2017, we didn't foresee the kind of impact demonetization would have, plus banking cleanup would have. There was the entire public sector bank which was sitting on huge NPAs. I think the difference this time is that not only are the balance sheet of corporates, even mid cap, small cap, way better than that time, but also the bank's balance sheet are way better than that time. So the credit availability is way better today. So, and then not a lot of companies don't even need that credit for growth because they are generating decent profits. So I think in terms of valuation, you are as good as what you were in 2017. But in terms of the quality, where companies just collapsing, going down, going bankrupt, that probability is very low. And whenever you see that, probably what happened in 2007-8 was that the balance sheets were over leveraged, and they were over leveraged in basically expansion into a lot of commodity like power and real estate and infrastructure, where there was no cash flow generation. It was all book profit which was generated. That's not the case. So I think even if markets go down, it won't collapse. What happens in 2017 or 2007-8 kind of a period. So that's where you get sort of a cushion. And again, but the bottom line is that you have to be invested in companies which will be able to double its earnings in the next 3 to 4 years. So even if you, instead of getting a 15 times multiple, you get it at say 25 times multiple, or instead of getting 20 times multiple, you get it at 30 times multiple. If your fundamentals deliver, then you should. And then again, that 15 times multiple again doesn't last for long, right? It will, like during COVID times, a lot of companies went to 12, 13, 15 times multiple. I mean, even in the index went to that level, but it lasted there for maybe 2-3 months. So if you have the ability to take the pain of seeing your portfolio crash by 30-40%, which will, and if you are sitting on really good quality companies which will double its earnings, then instead of maybe 25-26% return, you will make 13, 14, 15% kind of returns. But over that 3 to 4 year period, you will generally come out decent. If not, so even if like in our portfolio, people, I mean, we had stopped taking money, but there were 2 or 3 investors who did come in at the peak, towards December 17 or start of 2018. Even they have made 14-15% plus kind of annualized returns. But yes, they did go through the pain of their portfolio being down 20-25%. So, but it was, if you look at the portfolio, fundamentally it looked good. But just because the valuations crashed from 30 times to 15 times, even if your earnings was going up, you did have paper loss during that time. But in the end, the valuations will catch up to the earnings. Key is that the earnings line has to be uptrending, which is what will give you the biggest protection of your capital. Valuation will not give you the biggest protection of capital. The business is what will give you the biggest protection of capital. The protection of capital from valuation is very short term, but in the long run, the earnings growth and how the business delivers is what will give you the biggest protection of capital.
Right. So since you covered the aspect of valuations,
Kamal, your voice is again a little feeble.
Am I audible now?
You're audible, but it is, I think, very low volume.
Is it now better?
Yeah, you can go ahead. Yes, please.
Okay, sure. So, you covered the aspect of valuations. I wanted to understand from you, over last 1.5 years, we have seen, small and mid-cap stock prices rising. Obviously, it is backed by earnings also. And you mentioned the quality of, this bull run is different from the last bull run. But at the same time, it has been seen that over last, 2.5 years, SEBI also allowed mutual funds to invest more in small and mid-cap space. Right, more and more funds have come up to capture small and mid-cap space because more and more people have started accepting equity as an asset class, and people want to invest for long term. Today, we are seeing valuations of various startups at maybe at a very high level, which have been picked by various. If you see what is the average age of investors who are investing in Zomato's IPO, it's around 25, 26. Right, so basically there are more and more, I would say, new age investors also. If they are new age businesses, then there are new age investors also who are investing in equity markets, and that is how valuations are kind of rising. So this basically means that valuations are rising definitely because of earnings or maybe expected earnings, but much more than that because of too much liquidity and sentiment around it. Right. So today, over last 1.5 years, for example, Abacus has raised a huge amount of fund and put that into small and mid cap. Right. You would have also got a lot of inflow. Many mutual funds have got that inflow. So all these companies are maybe being bought by all these fund managers because more and more money is coming in and valuations are rising, and we are trying to substantiate these large high valuations by saying that this is a quality rally, these are quality businesses, one should focus more on the quality of business rather than valuations, which is the right point. But how do you see all these aspects which I have just covered, which basically boil down to that what are the risks over maybe next 6 months, 1 year? Over to you.
Yeah, no, I mean it's see. Forget about the newcomers. Even for experienced fund managers, it is very difficult to stay away from momentum, because see the media, the performance sort of comparison, puts you across saying that because if you look at that 2017 to 2000 March 20 kind of a rally, if you were a large cap, if you were managing large funds, you were anyways automatically putting that money into large caps and quality large cap. You significantly outperformed the small and mid cap. So you kept on getting more and more funds. Then post March 2020, if you see that the huge quality companies like Nestle and a lot of those have delivered zero returns. And in the meantime, there are so many small and mid caps who not only have doubled or tripled, many of them have gone up 10x in the last 1.5 years itself. Initially, you would, because you have gone through such a rough phase of couple 2.5 years, your focus is on protection of your capital. You would maintain that discipline. But when you see that your portfolio is going nowhere, or just up 20%, 30%, 40%, whereas the others in mid cap and small cap are going up triple digit, after a while you give up. And then as the rally continues, I mean, bhav bhagwan hai, right? So when the quality of stock is determined by the rise in the price of the stock, that price movement gives you a lot of confidence about the quality of business. And it's a false confidence, but that greed, moving from capital protection to just now making money, where you want to just participate, I think that's the phase we are reaching, because we do manage money for a lot of family offices, a lot of large investors, right? And they were majorly in cash. They were under allocated to equities, and a lot of who were even equally say allocated to equities, by the time they recovered the loss, June, July of 2020, or August, September, a lot of them booked profits. They wanted to create cash, because until that point, rallies used to be very short term. Now the rallies have continued even 1 year further down, and now they have no option but to come back into the market, because a lot of the family offices, they are also answerable. Like, how do you answer an underperformance of not like 5-10%, right? You're talking about 50, 60, 70%, or sometimes 100% kind of underperformance. How do you justify that? But you have no option but to jump into them. So investors will follow the momentum, and if fund managers get the money at that time, they have no option but to deploy that money. The question is, do you go after momentum, or do you really stay disciplined, that you stick with your core where you are good at? So I think that's at such moment, it's easy to jump into stocks which will go up maybe 30%, 40% just because you see a great quarter coming in. But I think, it's like Moh Maya. You should stay away from that. Stay with companies where at least you have 2 to 3 years kind of view, where irrespective of how this interest rates go up, down, and how India evolves out of this COVID crisis, they will be able to deliver that. So you have to focus on that. Otherwise, this thing, the way it has gone up, it can come crashing down equally easily, especially the stocks where there is no fundamental support. And as I said, that price movement gives you a lot of confidence. And that price movement is something where you can't stay away from. I mean, when you see a lot of metal stocks, cyclical stocks, even if you don't have the expertise to know what is going on in the companies or in the industry and what will happen 2 months down the line, you have no idea. Even then, you will jump in. I'm not saying that, I'm not taking a call on the metal. I mean, someone who is an expert probably knows what will happen in the next 6 months. But most of us are not, because we have not focused on those kind of stocks. You have spent like last 10 years focusing on quality and structural stories and all of that, and suddenly you can't become an you have to spend 10 years doing that. Only then you will know what will happen in the next even 6 months or one year. So that's the trap in which one should not fall. And it's very easy to fall because this greed is so much stronger than the fear that, and generally the crashes are short term, but these rallies can continue for years. And you just cannot bear that underperformance when people around you, are making so much money. And that's something which, however mature the market becomes, you cannot take that away from the investor behavior. It's something that you need to be aware, whether are you doing your investment based on just trying to catch up with the overall market, and even though it's not your expertise, or you are just jumping onto a lot of these momentum stocks because of them running up. I can tell you, most of investors jumping into these stocks because they are running up so fast. They want to make that quick buck, and it's a temptation which you have to stay away. But unless you destroy your wealth a couple of times, you cannot stay away from this temptation, and you cannot convince new investors to stay away from these stocks because they have tasted blood and they have seen that happening over the last 16 17 months. And who are you to tell them, right? They will have to evolve with their own strategy and burn their fingers. Only then that is the only thing which will teach them. You can tell you can tell them all kinds of things, but I mean, I've done the same thing, right? I mean, and you have to learn it. That only then you will have a sustainable learning which you will be able to utilize for the next cycle.
Sure. Well said. So, in fact, I would say that last 10 years were not that great
Kamal,
for India.
Sorry, but I think at the start your voice is a little feeble, and then after a little while,
So last 10 years, the growth has not been that great in India. Despite that, your portfolio has generated a 30% CAGR return, right? Which gives immense confidence, because a track record of 30% CAGR, and obviously there would be a periods, where there was a volatility and, but the total sum in terms of the accumulated wealth with 30% kind of a CAGR kind of makes up for the patience, which is what we understand, and very well said. But at the same time, today when we kind of want to invest, say in SageOne's investment portfolio, can you explain in simple terms what is the investment philosophy that you follow in terms of your sector choices, or in terms of your identification of particular businesses, any do's and don'ts? So I'm trying to give you a context, like Sunil Singhania or Abacus would say that they follow a principle of 15-15-15, where they will say they will identify those companies which are available at a PE lower than 15, right, which have a earnings growth of more than 15%, right, and which have a revenue growth of more than 15%. At the same time, Saurabh Mukherjee from Marcellus, he will say that I do not care about valuations. I am only concerned about return of capital employed of more than 15%, more than 10 years of history, and it should be a quality business, right? If valuations are kind of which do not matter. At the same time, Mr. Ramdev Agarwal from Motilal would say that they follow quality, they follow growth, they also follow price, and they also follow longevity, which is PUGLP, right? Now, in simple terms, if you have to explain what do you follow in terms of your philosophy in identifying stocks in your area of voting.
Right. See, the core is that we are after companies which will double their earnings in the next 3 to 4 years. Right. Now, how you do it is very important. Like I explained, what are the factors that you look for, right? It's because execution, as you can see, when you become an entrepreneur or when you evaluate companies, execution is the key. I can tell you, okay, my philosophy is investing in companies will double its earning in 3 to 4 years. But do you have the ability to do it? Can you find such companies? So I think it's important that you can't just look at history. You can't just study balance sheets. You can't just see how the ROE, ROCE, and a lot of parameters of history have been, and just assume that it's going to be extrapolated. And it is a lot of it is, especially in the mid and small cap, is all about understanding the business qualitatively, how the entire competition is positioned, and whether this company will be the disruptor, either by getting into newer products or just killing away the competition around it. So that is something which needs to be studied. I mean, it doesn't come up, you have to spend years, looking at different businesses, and you get a hang of, where it is possible. So that is one factor. So that ability of understanding businesses, going in depth, going on ground, studying the supply chain, studying the competition, and having some background about how companies strategize their growth is very important. And second is the valuation. So see, for me, valuation is important, meaning that first is the business. If I like the business, only then I'll look at the valuation. But valuation is somewhere where I can compromise a bit. Even if I think that the fair valuation for this company is 25 times, maybe, even if I pay 30, 35 times, I'm okay with it. But I cannot go wrong with the business. If I go wrong in business, I lose permanent capital. Whereas valuation, maybe I'll lose 6 months, 1 year kind of returns in that specific kind of a stock. And even valuation is very important, because I've done professional valuation for 4-5 years in Silicon Valley with Deloitte and Ernst & Young. There are, it's very tricky. Sometimes, people do keep on comparing PEG ratio and all of that, where PEG ratio for a consumer-oriented company versus a cyclical-oriented company will be completely different, because cyclical companies will never trade at more than like 10 times or 12 times kind of a multiple, where they can, in the long run, they can also grow at that 20% kind of a growth rate. Whereas consumer companies will trade at 60, 70 times kind of a multiple, whereas their growth rate will be 11, 12%. But doesn't mean that it's not a fair value, because in valuation, there are two big factors. One is the duration of growth. So a company where the duration of growth is only 5 years versus duration of growth is 25 years will trade at completely different multiples. One can trade at 15 times multiple, other can trade at 100 times multiple. And both will be trading at fair value because of the duration of growth. And second, most important factor, which I think an investor can judge, is what kind of investor does a company attract, right? I will give you an example. When Bajaj Finance changed its business profile itself from those unsecured lending to 6 or 7 verticals, where business become well diversified, it maintained margin, actually it increased its yield by 300 to 400 bips, from 13-14% to 17-18% kind of a yield. Business became much safer, and it became large enough that when it was small, it attracted investors like me who are looking for 25% return. But when it became large, when it became like 3, 4, 5 billion kind of a business, in 2012, 13, 14, it attracted investors who were looking only for 12% return, because it became safe enough for them to put their hands into it. Now, if you discount the business by 12% versus you discount the business by 18%, there itself, there is a difference of 4 to 5x of PE multiple. So if you get into a company where you know that in the future, this business will become much less risky, much more sort of reliable earnings growth, and large enough, then its multiple naturally go up. Same thing has happened with APL Apollo, where if you look at its 2000 last cycle, it used to have a lot of inventory gain and losses. Now it reduces inventory days to barely like a couple of weeks. So it doesn't have that kind of a huge volatility in its earnings. And as soon as you reduce the volatility, as soon as you show that you come out of a bad cycle stronger, and now you are a larger company, the investors who come in have much lesser expectation of returns. And that just skyrockets the PE multiple. And it has happened across. I mean, look at PI Industries. It was first into only about, selling pesticides in India, manufacturing. Then it got into custom synthesis, basically it's like contract research for, the larger pesticide companies across the globe. it diversified its revenue base. After all, the first revenue base was very cyclical because it depended on the monsoon for India only. But the second, when it gets exposed to the world kind of a monsoon, it gets little less riskier. And then the newer, profile was well diversified, more reliable margins. P multiple gets re-rated, and it happens across. So I mean, you can sort of have some if you understand how valuation works, you you can know that whether the P multiple has any potential of re-rating or not, because you will see which kind of investors is it attracting now versus which kind of investors will it attract 5 years down the line. As soon as the FIIs start investing, their returns are not 25%. They expect just 12-13% kind of return. Those are the kind of companies it looks for. Whereas when I am looking for companies, for me 12-13% is not enough. I would look for 25% kind of a return. So obviously, I will give much lesser multiple, and obviously it comes with some risk. But then if I can see how this is going to evolve, again, as I said, out of the 15, 16, I will not get all of them right. But even if I get 3 to 4 of them right, it has a huge impact on the P multiple, and that's what drives the P multiples 2x or 3x or 4x, in addition to your earnings growth.
So you are quite confident that even at these levels of markets and at these valuations, it is possible to identify such companies which can give 10x kind of return over the next 10 years.
See, it is becoming more and more difficult, right? So again, the returns are, as you would know, is that it is very concentrated in short period of time. But again, as everyone would say, that timing the market is very, very difficult, right? So in this kind of market, as I said, you can't really bet on earnings or the P multiple re-rating. There are 1 or 2 businesses which you may find, but again, you are not going to get it at 15 times multiple or 12 times kind of a multiple. You will have to pay 20, 25 kind of multiple minimum. Right? Question is, will the fundamentals deliver? Because your expectation of returns have to drop when you enter at the peak of the market. But you will, I think, even if you enter at the peak and the earnings are delivered, you will make that 15-16% kind of a return, even if the P multiples crash. But if you get into these momentum stocks, where they probably short run, they have peak margins and peak business, but then they will plateau off or it will even contract. Then, and if their earnings don't grow from this point, if they just stay flat for the next 3 years and their P multiple drops by 30%, you lose 30%. Right? So that is the big risk. What I'm saying is that there is no way you can always get great valuation, whatever. I mean, in this kind of market, where do you get? Whichever fund manager says that you will get it, a lot of these, in low teens or single digit, it's not possible to get it for any reasonable quality business. So you will have to do whatever best you can do in every kind of a market. And what is in your hand is the fundamentals of the business. P multiple will go up and down. And unfortunately, as I said, momentum is such a huge sucker that it will suck in a lot of investors, and they will be fine paying that kind of multiple. But as a fund manager, you should not fall for momentum, because that's what you get paid for. That you see through, because you've experienced multiple cycles, you see through the risk that this will create. And you don't have to go for that kind of a risk. If you just stick with your core of finding fundamentally strong companies, and which may not be like the quality companies that everyone looks for. A lot of these are B2B companies where not many investors know about these companies. So like not many investors knew about APL Apollo or Deepak Nitrite like 4 years, 5 years. They were not called quality companies. But you will have to spread your bets so that they have the earnings potential and they would be called quality companies, 3-4 years down the line. And so your higher allocation will be towards those kind of businesses. APL Apollo, Deepak Nitrite will still be in your portfolio, but they will not be the highest conviction kind of an ideas at these kind of valuation.
Right. So now you're launching a new alternative investment fund, which is again fulfills your forte, focuses on your forte of mid and small cap space. right? And over a period of time, that fund will build its portfolio. And I wish you, good luck for that. And today's interaction has given us deep understanding of your, quality approach to identifying future businesses, right? Where your focus is more on the, those attributes which will actually be drivers for future growth, rather than relying too much on the historical growth. And your background, which is as you are hailing from consulting background, right? Business valuations background, mergers and acquisitions background, kind of provides you, I would say, strength in identifying those future drivers. So which kind of differentiates your style of investing absolutely uniquely from rest, and it gets substantiated by the track record of 10 years, which we have already covered. So I really admire that, and it has been absolutely insightful interacting with you. One last question I would want to ask you, and then we would end this session. What is your view of these IPOs which are coming up? Zomato, Swiggy, and many more lined up. There are many funds also which are trying to market and trying to collect a lot of money from investors to invest in these IPOs. These IPOs are coming at obnoxious valuations, right? Because you come from that background of understanding these business valuations, and we have discussed on this topic a lot. What is your view, with regards to these, investing? Is this space of these new age businesses, which are available at high valuations? If we invest in these businesses, can one expect 10x kind of returns? What are your views? Or one will lose money entering at these levels, right? So
Right.
over to you.
Sure. Just thanks for talking about the AIF. Just one thing that we our biggest problem was that we don't take below 2 crore kind of ticket size, and that was a key reason that AIF, where we can lower the ticket size to 1 crore. So a lot of investors requested, why don't we launch something which is below? I mean, we had launched an AIF which doubled in 1.5 years or that kind of a period. Here, obviously, the target is doubling in the next 3 to 4 years. That will always be the target. And thanks for talking about that. See, my view on the IPO, again, it's all about individual businesses. Like when you look at Zomato, which comes in at 30 price to sales multiple. If you look at globally, companies like Meteon and Grubhub and Uber, these kind of platform companies, they trade at 5 to 8 times kind of a price to sales, right? So if you assume that 10 years down the line, this 30 multiple will drop to say somewhere around 6 times multiple, that means 1/5. You will have to grow 5x top line just to compensate for the drop in the multiple, the price to sales multiple. No one knows about the profit, so I'm not going to talk about P multiple and all of that. So then the returns will come from over and above 5x. What is the growth that you can deliver? And then these are not tiny companies. They are already entrenched into the metros, tier 1 and tier 2 kind of cities. So it's not like they are just starting and our internet penetration and smart core access is just at the initial phase of sort of penetration. They're already at a pretty high rate. So, I mean, I am not an expert in those industries, but just prima facie, what I see is that it's mathematically looks very difficult to generate 10x in 10 years kind of returns. But yes, I mean, every investor has its own set of excited investors, and it attracts such valuations. But at least, I mean, if you look at the IPOs today, I mean, a lot of these tech IPOs, they're pretty good quality companies which have come into the market. So, whether it's the Gland Pharma or even this Krishna Diagnostic and all of that, I mean, they're pretty profitable companies, been there for a while. So, at least we are not seeing like really poor quality kind of IPOs which are coming. Unfortunately, the valuations are out of the world. And that's where, you don't even dare to touch a lot of these IPOs. But even a lot of the good IPOs, people have made money. It's not for our kind of investment style, because you do make money in this, but it is something where, again, it's all about disruption. Zomato is all about, completely disrupting and whether it can become the dominant player, where the second player maybe just retains 15-20% of the market share. That is something which is, again, you need that understanding of that business. Unless you really understand whether this 50% market share is going to go to maybe 80%, 90%, or just destroy the other player, it looks very difficult that the top line can grow 5x because it's 20% growth over the next 10 years, which is not that easy, especially at this kind of scale. So it's an exciting period. It's good because it's good for India. A lot of this funding which is happening to Zomato is creating such a big employment to a lot of people who have been unemployed because of this huge move from unorganized to organized. So I feel it's not just about the stock market, but this Zomato and these kind of companies are I think great for a lot of unemployed youths in India. And I completely support the business. I mean, I'll be happy user of their services, as well as they are doing great service for the population of India as well as for employment.
Sure. And I think, what I have learned is that ultimately higher price is given to higher quality because quality is rare. And that is why, it commands higher price. And that is why you also confidently mentioned that one's focus should be more on quality. And the only thing that one needs to be understood at a portfolio level from investors' perspective is that if you invest in the quality in the large cap space, you can expect around 12% return. But if you invest in quality in the mid cap space, you can expect around maybe 18% kind of return. And at the same time, if you keep a 10-year horizon and also follow a high conviction approach of a focused portfolio, then you can expect a 10x kind of a return, in 10 years. Because that mathematics applies that 2-3 such quality businesses will actually give you 50 times returns like Bajaj Finance gave over last 10 years, right? So absolutely, bang on. And that is where, we would like to end with these words. Thank you, everyone. All the viewers have been very patient watching this for more than 1 hour. It was so interesting and it went ahead of its schedule. And, if any investor is keen to know more about SageOne or do any investments, you can book a call with us. We are a well-known, well-trusted wealth management platform backed by, the new ways of investing, which is knowledge-backed approach of investing. Thank you, everyone. Thank you so much.
Thank you so much. Thank you so much, Kamal. And thank you, everyone, for listening.
It's my pleasure.